Ever wondered how you can minimize your tax liabilities? Welcome to our enlightening journey where we'll explore 10 powerful strategies to plan your taxes and minimize liabilities. As you move along, you'll discover how the right knowledge and a smart approach can turn the daunting task of tax planning into a smoother experience. So gear up to learn some practical, actionable tips that can help you make the most of your hard-earned income. Let's dive into our countdown with strategy number 10. Coming in at number 10, we have utilizing tax credits. Now, what exactly are tax credits? Think of these as a way to offset your tax liabilities. They are a dollar-for-dollar reduction of your tax bill. Pretty neat, right? Let's delve into some common types of tax credits that you may be eligible for. First up, we have the Earned Income Tax Credit. This is for folks who earn a low to moderate income. Then, there's the Child and Dependent Care Credit, which can come in handy if you're paying for the care of a child or a dependent. And let's not forget the American Opportunity Credit, designed for students paying for education expenses. Each of these tax credits has specific eligibility requirements, so it's crucial to do your homework to see if you qualify. Remember, tax credits are a dollar-for-dollar reduction of your tax liability. So, why not make the most of them? At number 9, we suggest leveraging tax deductions. Tax deductions are a savvy way to strategically lower your taxable income. But what exactly are they? Simply put, tax deductions are expenses that you can subtract from your gross income. This subtraction then lowers your overall taxable income, and less taxable income means less tax to pay. Let's delve into a few common deductions. For instance, there's the standard deduction, an amount that everyone can subtract from their income. Then there's the itemized deduction, which includes expenses like mortgage interest, state and local taxes, and charitable contributions. If your total itemized deductions exceed the standard deduction, it could be beneficial to itemize. But remember, tax laws are complex and change frequently. Always consult a tax professional to ensure you're maximizing your deductions and therefore your savings. Reducing your taxable income can result in significant savings. So, let's leverage those tax deductions to our advantage. Number 8 on our list is investing in retirement accounts. Now, retirement might seem a long way off, but the sooner you start investing, the better. Why? Well, retirement accounts offer significant tax advantages. Let's break it down. Firstly, most retirement accounts offer tax-deferred growth. This means the investments in your retirement account grow over time without being subject to taxes each year. It's only when you withdraw the money in retirement that you'll pay taxes on it. Secondly, many retirement accounts allow you to deduct your contributions. This means you can reduce your taxable income for the year, potentially lowering your tax bill. Imagine the money you put into your retirement account as a tax shield, protecting you from paying more than you need to. So it's clear that investing in retirement accounts is a win-win situation. You're not only preparing for a comfortable future but also minimizing your present tax liabilities. Investing in your future can also provide you with tax benefits today. At number 7, we have considering tax-advantaged investments. Tax-advantaged investments are essentially financial products that offer tax efficiency to the investor. These can be as diverse as real estate investments or health savings accounts. Let's take a closer look. Real estate, for instance, provides multiple tax advantages. Depreciation, mortgage interest deductions, and capital gains exclusions are just a few examples. With health savings accounts, or HSAs, your contributions are tax-deductible and withdrawals for qualified medical expenses are tax-free. There are many other types of tax-advantaged investments as well, such as education savings accounts and certain types of retirement accounts. The beauty of these investments is that they provide a double benefit. Not only do you potentially earn returns on your investment, but you also save on taxes. So, whether you're saving for retirement, healthcare, or education, tax-advantaged investments can play a crucial role in your financial strategy. Strategically choosing your investments can provide significant tax benefits. Halfway through our countdown at number 6 is making charitable contributions. This selfless act can benefit you in more ways than one. By donating to eligible nonprofits, you can reduce your taxable income. This is because the government encourages philanthropy by allowing you to deduct these donations. However, remember to keep a record of all your contributions and ensure that the organization you're donating to is eligible for tax-deductible donations. Giving back can also help reduce your tax liability. Coming in at number 5, we recommend maximizing your health savings account. Health savings accounts, or HSAs, offer a triple tax benefit. Contributions are tax-deductible, earnings grow tax-free, and withdrawals for qualified medical expenses are also tax-free. By maxing out your HSA contributions, you effectively lower your taxable income. This strategy is not just about saving for healthcare costs, it's a savvy move for minimizing your tax liabilities. Maximizing your HSA can lead to substantial tax savings. At number 4, we have planning for estate taxes. Now let's talk about something that might not be on your immediate radar but is incredibly important: estate taxes. When it comes to preserving your hard-earned wealth for the next generation, planning for estate taxes is key. Estate taxes are levied on an heir's inherited portion of an estate if the value of the estate exceeds certain limits. Without proper planning, these taxes can take a significant chunk out of what you leave behind for your loved ones. By taking steps today, such as setting up trusts or gifting assets during your lifetime, you can significantly reduce the potential tax liabilities your heirs may face. It's all about thinking ahead. Remember, estate tax laws vary by location and can change over time, so it's essential to regularly review and update your estate plan with a tax or legal professional. Proper estate planning can save your heirs from a hefty tax bill. At number 3, we suggest utilizing a tax-deferred savings plan. Now what does that mean, you ask? Well, a tax-deferred savings plan is a financial arrangement that allows taxpayers to pay taxes on their savings at a future date rather than in the current year. This can significantly reduce your current tax liabilities. These plans come in various forms, including individual retirement accounts, or IRAs, and 401(k) plans. Each type has its own set of rules, including contribution limits and withdrawal regulations. For example, in the case of a traditional IRA, contributions are often tax-deductible, but withdrawals during retirement are taxed. However, it's important to remember that there are penalties for withdrawing funds before a certain age, typically 59 and a half. So, these plans are best for long-term savings. So, if you're looking for ways to reduce your tax bill now, while saving for the future, consider a tax-deferred savings plan. A tax-deferred savings plan can provide immediate tax savings. Second on our list is considering tax loss harvesting. So, what exactly is tax loss harvesting? It's a strategy used by savvy investors to reduce their taxes on investment gains. The idea behind it is pretty simple. You sell off investments that have decreased in value to offset the taxes on investments that have increased in value. But just like any other tax strategy, there are rules and limits to consider. For instance, you can't simply sell a losing stock and then immediately buy it back. This is known as a wash sale, and it's not allowed by the IRS. Moreover, you can use tax loss harvesting to offset an unlimited amount of capital gains, but if your losses exceed your gains, you can only deduct up to $3,000 of those losses against other income. So, while it may seem a bit complex, with careful planning and execution, tax loss harvesting can be a powerful tool in your tax planning arsenal. Tax loss harvesting can help reduce your capital gains tax liability. And finally, our top strategy for minimizing your tax liabilities is hiring a tax professional. You see, tax laws are complex and constantly changing. They are a labyrinth of rules, regulations, and exceptions that can be a challenge to navigate. This is where a tax professional steps in. These experts have dedicated their careers to understanding the intricacies of tax laws. They are trained to identify the deductions and credits that you may not even be aware of. More than just a preparer of your tax returns, a tax professional can be your strategic advisor. They can provide year-round tax planning services, helping you make smarter financial decisions that can lead to significant tax savings. Moreover, in case of an audit, they are your trusted ally, defending your case and ensuring your rights are protected. A tax professional can help ensure you're not paying more than necessary in taxes. Remember, tax planning is an ongoing process, not a one-time event. Stay informed, stay prepared, and keep your tax liabilities to a minimum.